A second passport costs $150,000. And for the right person, it cuts the annual tax bill by $50,000. In 2025, roughly 5,000 high-income professionals will do something that sounds extreme. They will pay a Caribbean government between $150,000 and $250,000, sit through 6 months of background checks, and walk away with a second passport. To most people, this sounds like either paranoia or vanity. It is neither. For a very specific type of earner, that passport is a math problem with a $50,000 per year answer. Because your passport is not just a travel document, it is a tax lever. The country printed on the cover, combined with the country you sleep in at night, determines exactly how much of your income the government keeps. Change the passport, change the residency, and a $100,000 tax bill can legally drop to $10,000. This is not tax evasion. It is the 5 most used citizenship-by-investment programs, stacked against the 3 lowest tax residency jurisdictions in the world, used by an estimated 65,000 high earners to legally relocate their tax base every year. And almost nobody explains how it actually works. Most people think a passport just lets you travel. For tax purposes, it does something more important. It defines the one country that can tax you no matter where you live. In every country except 2, tax is based on residency, not citizenship. A German who leaves Germany stops paying German tax. A Frenchman in Dubai pays 0% French tax the moment he moves his life there. The 2 exceptions are the United States and Eritrea. If you hold a US passport, the IRS taxes your worldwide income forever, even if you have not set foot in America in 20 years. This is called citizenship-based taxation, and it is the reason American expats have to file US tax returns every year no matter where they are. Every other developed country uses residency-based taxation, which means for non-Americans, the playbook is simple. If you can legally move your tax residency to a 0% country, your tax bill drops to 0 automatically. The problem is that governments know this. They make it hard to prove you actually left. You need an address, a visa, a tax certificate, and often a passport that lets you stay in a low-tax country for long enough to qualify. That is where the second passport comes in. The cheapest way to get a second passport legally is a Caribbean citizenship-by-investment program. 5 countries run them. St. Kitts and Nevis, launched in 1984, is the original. You donate $250,000 to the government or invest $400,000 in approved real estate. Processing takes 4 to 6 months. No residency requirement, no language test, no interview in most cases. Dominica offers the same deal for $200,000 donation, $200,000 real estate. Grenada starts at $150,000 donation. St. Lucia starts at $240,000. Antigua and Barbuda starts at $230,000, but requires 5 days of physical presence over 5 years. Every one of these passports gives visa-free access to 140 to 155 countries, including the UK, the European Union Schengen area, Singapore, and Hong Kong. Crucially, none of them impose any income tax, wealth tax, or capital gains tax on citizens who live abroad. You can hold the passport, keep your original citizenship, and use the new passport only when it is useful. And for tax residency planning, it is useful in exactly one way. It gives you a legitimate base to move to, which is the hardest part of unwinding your original tax obligations. If $150,000 sounds cheap, the trade-off is that a Caribbean passport does not give you EU access. For that, you need a European program, and Malta runs the only true citizenship-by-investment route in the EU. The official name is the Maltese Exceptional Services by Direct Investment Program. Total cost is roughly $830,000 to $1.1 million, including a government contribution of $600,000 to $750,000, a property purchase or rental, and a charitable donation. It requires 12 to 36 months of actual residency in Malta before the passport is granted. In return, you get an EU passport with free movement across all 27 member states, plus visa-free travel to roughly 185 countries. Portugal used to offer the Golden Visa with a pathway to citizenship after 5 years for a €280,000 real estate investment. That program closed to new real estate applicants in 2023, but the investment fund route remains open at €500,000. Spain, Cyprus, and Greece run similar residency-by-investment schemes, but they do not grant citizenship directly. For tax savings, the Caribbean passports are usually the better buy. They cost 10% of the Malta program, they carry no minimum stay, and the visa-free reach is sufficient for most professional needs. EU citizenship is mainly worth the extra cost if you want to live and work anywhere in the EU. Having a second passport does not change your tax bill. Changing your tax residency does. The passport is the tool that makes changing residency legally possible. Most countries define tax residency using one of 3 tests. Test 1 is the 183-day rule. Spend 183 days or more in a country in any given tax year, and you are usually considered a tax resident there. Test 2 is the Center of Vital Interests test. This looks at where your family lives, where your business operates, where your assets are held, and where you maintain your main home. Test 3 is the Habitual Abode test. If you are not clearly resident anywhere, tax authorities look at where you spent the most time over recent years. To legally escape your original country's tax system, you typically need to do 3 things at once. Reduce physical presence in the old country to below 183 days, preferably below 60. Establish substantive ties, meaning a real home, bank account, and local ID in a low-tax country, and hold a legal right to live in that low-tax country, either through a resident visa or through citizenship. The second passport solves the third requirement. With a Caribbean or Maltese passport, you can walk into the United Arab Emirates, Monaco, Panama, or Paraguay, establish residency within 2 to 8 weeks, and legally claim that jurisdiction as your tax home. That combination is what creates the $50,000 annual savings. Americans play a different game, and it is harder. Because the United States taxes by citizenship, no amount of moving abroad cancels the IRS bill. The only legal way out is renunciation, and renunciation triggers one of the most aggressive tax rules on earth. The expatriation tax, known as the exit tax, applies to anyone who qualifies as a covered expatriate. You become covered if your net worth exceeds $2 million, or your average annual U.S. income tax for the last 5 years exceeds $190,000 in 2024, or you have failed U.S. tax compliance in any of those years. Hit any one of these tests, and the IRS treats your renunciation date as if you sold every asset you own that day. Unrealized capital gains above $821,000 in 2024 are taxed at the standard long-term rate. Retirement accounts like 401 Burmese Chats and IRAs are deemed distributed, triggering full income tax on the entire balance. Specified tax-deferred accounts are subject to a 30% withholding. For an American with a $10 million net worth and $3 million in unrealized gains, the exit tax bill alone can exceed $700,000. This is why American expats overwhelmingly do not renounce. They instead use the foreign earned income exclusion, which shields the first $126,500 of foreign wages in 2024, combined with foreign tax credits for taxes paid abroad. The savings are real but smaller, usually $20,000 to $35,000 per year rather than $50,000. Here is the actual math on a $50,000 savings. Take a 38-year-old British software engineer earning £180,000 per year from a UK limited company. Living in London, her effective UK tax rate, including national insurance and dividend tax, lands around 42%. Her annual tax bill is roughly £75,500, or $95,000 US. She buys a Grenadian passport for $150,000. She moves to Dubai, qualifies for a freelance residency visa within 6 weeks, and restructures her UK company into a Dubai Free Zone company. She physically lives in Dubai more than 183 days per year, keeps no UK home, and severs every center of vital interest tie. The United Arab Emirates charges 0% personal income tax. Her new annual tax bill on £180,000 of income, after Dubai corporate tax on company profits above 375,000 dirhams, is roughly $14,000. Annual savings, $81,000. Net of living costs, which are actually cheaper in Dubai than London, real savings are around $50,000 to $55,000 per year. The Grenadian passport pays for itself in year 3, and every year after that is pure arithmetic. The passport itself did not reduce her tax. The ability to move residency freely, because she now holds a passport that governments accept without question, is what reduced her tax. The $50,000 number assumes you do the structure correctly. For specific traps, destroy it for most people. Trap 1 is controlled foreign corporation rules. Many countries, including the UK, Canada, Australia, and Germany, attribute the profits of a foreign company back to you personally if you own more than a certain percentage and actually control it. Moving to Dubai but still directing your UK company from Dubai can trigger CFC rules that ignore the offshore structure entirely. Trap 2 is source country taxation. Even if you are a tax resident of Dubai, income sourced from your old country, rental income on a London flat, dividends from UK stocks, salary for work physically performed in the UK, is still taxable in the UK at source. Non-residents pay UK tax on UK source income. Trap 3 is the common reporting standard. Over 110 countries now automatically share bank account information with each other. If you hold a Grenadian passport but keep an undeclared bank account in Canada, the Canadian Revenue Agency and the Grenadian Tax Office both see it within 12 months. Trap 4 is visa failure. Most Dubai Free Zone residency visas require a minimum business activity level or a minimum salary. Fail the requirement, and the residency lapses. Lose the residency, and the whole structure collapses back to your old jurisdiction. There are 3 legitimate strategies that actually produce the $50,000 annual savings. Strategy 1 is the Caribbean passport plus Dubai residency combination. Total setup cost, $150,000 to $250,000 for the passport, plus roughly $15,000 for the Dubai freelance visa and business setup. Best for tech workers, consultants, crypto traders, and e-commerce operators with $150,000 to $500,000 annual income. Strategy 2 is the Maltese passport plus Portugal non-habitual residence combination. Maltese citizenship costs $830,000 and takes up to 3 years. Portugal's Inchar regime, though restricted since 2024, still offers 10% tax on foreign pension income and a 20% rate on certain professional categories. Best for high net worth retirees and senior executives with $500,000 plus net worth. Strategy 3 is the Paraguayan or Panamanian residency route, which does not require a second passport at all. Paraguay offers permanent residency for a $5,000 bank deposit and charges 10% personal income tax capped. Panama's Friendly Nations visa costs roughly $8,000 and delivers territorial taxation, meaning foreign source income is entirely untaxed. Best for digital nomads and remote workers with $80,000 to $150,000 income, where the Caribbean passport is overkill. The common thread across all 3 is that the structure must be real. A mailbox in Dubai and a suitcase in London does not qualify. Tax authorities increasingly require proof of substance, and proof of substance is what a second passport, combined with an actual move, legally provides. If this kind of real numbers, no hype tax map is what you're looking for, subscribe for more. Every week we break down one country, one loophole, or one real workaround the other channels skip. Hit the bell so you don't miss the next one. We'll see you in the next video.